Welcome back to The Explainer. Today we're diving into the battle for Eles, boardroom drama, and undervalued tech. We're going to break down a really fascinating developing corporate standoff that perfectly shows what happens when intense boardroom proxy wars collide with some deeply undervalued assets. So let's just jump right into the mechanics of this thing.
Okay, picture this. It's January 2026, and we are right in the middle of a fiercely contentious shareholders meeting. The current board of Eles attempts to bring in a new independent director and, revise some compensation, but they hit an absolute brick wall. Mare Group, acting as the heavy-hitting primary shareholder, uses this massive voting bloc, we're talking at least 46% of the represented quorum, to just flat-out reject those proposals. The board is suddenly left without its minimum required independent members, triggering an instant governance crisis. It's basically a textbook proxy maneuver executed right there on the floor to paralyze the board's agenda.
We're essentially looking at a clash between two totally different worlds here. On one side, you have Mare Group. They're an ambitious engineering firm listed on the Euronext Growth Milan, really heavily focused on enabling technologies. And on the other side is Eles, a highly specialized semiconductor testing company. From the outside, Eles is posting some incredible financial results. But internally, their governance structure is just being systematically dismantled by their largest investor.
But, as the impartial observers, we really have to stop and ask the obvious question. What exactly is driving this? Proxy battles and boardroom coups don't just happen by accident, right? They take a ton of capital, legal maneuvering, and just intense corporate focus. So what makes Eles so incredibly valuable that it kicked off this whole aggressive proxy war? Well, to figure that out, we have to look past the drama and look at their actual tech and financials.
To really get this conflict, you have to understand what Eles actually does. They aren't just some run-of-the-mill manufacturing plant. They are legitimate deep tech pioneers. They've been in the game since 1988, and they developed this really innovative testing solution called RETAP. It's basically a test for reliability approach that lets manufacturers test the performance and the reliability of a semiconductor at the exact same time. In the hyper-fast world of chip manufacturing, any process that saves you time while locking in quality is an absolute goldmine. And here is where the financial engine really starts to roar. Independent equity research from KT & Partners showed some massive momentum. In just the first half of 2023, Eles posted a huge 44% year-over-year jump in sales revenues. And they weren't just burning cash to grow either. They were holding on to really healthy EBITDA margins, right around 14%. So they're expanding their market footprint while keeping their profitability totally intact.
Okay, now here is the kicker. And this is really where the mystery of the proxy war starts to make a lot of sense. Despite all that fantastic growth, Eles was trading at a staggering discount. When analysts looked at the enterprise value to EBITDA multiples for 2024, Eles was sitting at a remarkably low 3.6x multiple. Compare that to their industry peers, who were commanding a median multiple of nearly 16x. Put simply, Eles was generating amazing cash flow, but the stock market was practically ignoring them.
The discrepancy gets even crazier when you look at intrinsic value. By running discounted cash flow models and crunching the market multiples, those analysts calculated the actual fair value of a single AG's share to be exactly €3.44. Based on their real-world tech, their assets, and the cash they generate, that's what the company should actually be worth. But the market? The market was pricing an Eles share at a mere €1.36. That is a massive, massive inefficiency. For an ambitious firm looking to expand, that's basically a giant neon on-sale sign sitting right there in plain sight.
So the whole thing boils down to this huge valuation gap. When a company's fundamentals are firing on all cylinders like this, but its stock price is heavily suppressed, it's the exact kind of mismatch that invites a dominant shareholder to swoop in. Mare Group didn't just accidentally stumble into a boardroom fight. They saw that Eles' stock price was completely disconnected from reality, and they mobilized to grab that unrealized value.
Which brings us to the escalation. Moving from just blocking the board to an outright acquisition strategy, Mare Group took things to the next level. They didn't just sit on their 46% voting power. They launched a voluntary public tender offer targeting all of the company's shares and outstanding warrants. It's the classic way to bypass a board that won't play ball. You just take a structured, cash-backed offer straight to the shareholders.
And they're being incredibly strategic about the terms of this offer. Mare Group made it crystal clear that they wouldn't be handing out their own shares. They absolutely do not want to dilute their existing shareholders. Instead, they offered a flat cash amount of 0.025 euros for each Equus warrant. But the real genius move here is their stated intent. They plan to eventually exercise those warrants to inject fresh capital straight into Equus, so they're funding the company's future growth without diluting their own equity. It's a very smart play.
And get this, they aren't even waiting for the tender offer to wrap up. This is a total multi-front campaign. While the financial offer is actively on the table, Mare Group sent demands to Eles to update the proxy voting forms right away. Their goal is to make sure shareholders have clear instructions to vote in Mare Group's own handpicked independent directors immediately. So they are aggressively taking over the governance structure at the exact same time they're making a play for financial control. So, as this whole complex, multi-layered tug-of-war plays out, we're left with a really fascinating situation. You've got this brilliant semiconductor testing pioneer that just got overlooked by the market, caught right in the crosshairs of a group determined to unlock that value by any means necessary. It really makes you wonder, will this aggressive, two-pronged attack finally force the market to recognize that 344 fair value? Or is this corporate drama just getting warmed up? We'll definitely be keeping an eye on this one because it is a perfect real-world masterclass in how market inefficiencies drive modern corporate conflict.